Welcome to the Coverage and Coffee podcast. My name is Caspar Harsey. Joining me is Mo Mirzan, and today we're talking ENS.
That's excess and surplus for those unfamiliar.
Yeah, so last time we were talking about Nat Cat on a kind of global scale, providing a couple of specific examples. And we ended off talking about the current situation in Florida, California, Texas, in terms of how the insurance market has been adapting to some of these larger natural catastrophe type events like Hurricane Ian, how the national flood insurance program in the US is losing its funding. And this is not something that has just been going on for with no type of, I guess, changes, right? It's led to some changes, and that is excess and surplus.
Yeah, absolutely. I mean, I think it's pretty well known that the major driver of the shift from admitted carriers like your Allstate, like your State Farm and so on, to these ENS carriers has been driven by factors um, concerning, I suppose, climate change.
Yeah, and we'll be focusing specifically on excess surplus and what it actually means for people getting insurance, how it actually changes the dynamics of the industry a little bit. The excess and surplus market is not something that's necessarily new. It's something that kind of has been an existing concept within the insurance market. It's supposed to be for these hard to place risks, right? If you're looking at it more recently, before this big boom, that would be things like your cannabis farmers, right? Where there's regulation difficulties, the market is new, and there's this uncertainty or inability to necessarily model it, right? There's cyber insurance, which we'll talk on a little bit later, that in its infancy was very much around the ENS market and was more similar to wholesale as we know it in London, right? In the sense that it focused on that excess and surplus, that specialty aspect of the insurance required.
Yeah, no, for sure. I think, like you said, where you'll kind of see things like ENS pop up is in these sort of, don't want to say gray, but somewhat uncertain markets. And so what ENS does, I think, there is they kind of fill the void and allow risks to be insured that normal carriers will just outright refuse to insure because they just don't have an understanding of how the risks work in that category or in that sort of department. Obviously, this comes with a certain amount of additional premium, right? Because these ENS carriers are, they're underwriting these risks, and they expect a bonus on the fact that other people aren't writing these risks.
Yeah, and there's so many other factors into why ENS ends up being more expensive. There's typically taxes on ENS premiums on a state by state basis, where normal insurance providers are not paying those same taxes. They're paying like operational fees. They're licensed in those states, and I think that's a good place to start in the sense of why are we seeing this big discussion kind of falls into this admitted versus non-admitted insurer. Now, just generally, today's episode is going to be quite US focused, at least here in the start, because ENS is something that's really growing in the US. Traditionally, when we're talking about these difficult to insure risks, that would fall under this specialty segment of the wholesale market. And you'd see these people come here to Lloyd's, they would come to London, and they would place these bespoke placements here. But now there's always been some sort of specialty domestic placement in the US and in a lot of countries. But what's really led to this change is this classification of admitted and non-admitted. What this means in the US is that insurance providers are actually regulated on a state-by-state basis, and they apply to operate and to be insurance providers within a state through some sort of regulatory board, some sort of insurance board. It actually differs on a state-by-state basis. But to be admitted, that means that you've gone through that state's regulatory requirements. You are licensed to provide insurance, and then you are classified as a admitted insurer in that state. So even before this, there were insurance companies that weren't necessarily admitted in every single state, right? Regional insurers, things like that. But now what we're seeing is based on these Nat Cat events, companies like you mentioned, Allstate, NatWest, these kinds of insurance companies are pulling out of some of these harder to place markets like Florida, like Texas, like California. And that's creating a vacuum for these non-admitted insurers, right? So these excess and surplus lines insurers.
Yeah, just to kind of expand a bit on the whole admitted versus not admitted, what that typically means from a regulatory perspective is that, um, for an admitted insurer, they'll be able to, insure these risks. And because they are regulated by the state's sort of commission, what will happen is that there is a sort of backstop. So in the event of, a large scale disaster or anything of that nature, and the insurers find themselves unable to, pay the full amount of the claim, the actual state will step in and provide the funds to make sure that these claims are fully paid out. Now, with an unadmitted insurer, that's kind of where things get a little bit dicey, perhaps.
Yeah. So because they're not regulated state by state, they don't have the same requirements, not only when it comes to these federal backstops, these state by state backstops, they don't have the same requirements in terms of having to rationalize their pricing, which is such a crazy concept. They don't have the same minimum hold requirements, right? Like if you get insurance from a admitted insurer, let's say they have a fund of $100 million to provide insurance, right? That's $100 million worth of claims that they can pay out. Don't know the exact numbers. It probably changes state by state. But let's say in one state, you need 10% of that fund to remain on hand, right? That means that you can really only give 90% or $90 million worth of insurance to people, $90 million worth of coverage, because you need 10 million to pay these claims out. You can't say, hey, I owe you when this premium comes in from the business that we have that we'll pay you back then, right? But when it comes to excess, when it comes to these non-admitted insurers, they don't have to rationalize how they got to their pricing. They don't have to keep this funding, off to the side. They don't actually have to make a business case on what their longevity or what their long-term plan is for running a successful insurance company, which obviously has repercussions for consumers, right? Like, let's say you're in one of these non-admitted states, so you're in Florida, you're in Texas, you're in California, and you get your property insured, you get your house insured. Lo and behold, another natural catastrophe event occurs. Your house, suffers damages in that time. But then everyone in these E&S insurers portfolio, because they're specifically targeting this market, right, this uninsurable market, all the people who have this same risk all of a sudden have a claim, and they're not able to pay you out.
Yeah, absolutely. I mean, we've really talked about this at length off the podcast, and I think while we're seeing record growth in this sector, and I mean, just for reference, in 2024, I mean, we're talking about gross written premiums of 19.1 billion US, up from 16.6 in 2023. I mean, it is a booming segment of the market, especially in North America. But I think, due to a variety of factors, including the fact that, the last couple of years have been relatively mild in terms of natural catastrophe in North America. You didn't have the high frequency of large hurricanes that we've seen maybe in the past. The strength and the ability for this sort of E&S market to fully pay out the claims that, are incurred during one of these disasters has yet to really be tested. So I think there is still a lot of questions about the overall sort of market, the market health. And I think there is this kind of, how should I say this? I suppose, sort of this sort of sword hanging over everyone's heads about how, this might turn ugly quite quickly.
I mean, I'll be more explicit than that. I think when you search ENS, it's so interesting because the only news articles you see are this, story around growth of the market, right? No, like actually finding articles. And if you're watching on YouTube, you'll see that we throw screenshots and stuff. But actually finding articles to tell a story or to dive a little bit deeper into ENS is incredibly difficult right now. There's a lot of conversation around this growth. I mean, 2018, this market was a fraction of the size that it is now, right? And just like you said, we haven't had a big event since Ian, really, right? Ian is the big landmark event that we can really compare.
Well, I suppose
to.
you also had the Palisades fire, but I'm assuming a lot of that damage would have been covered by existing admitted carriers.
Yeah, I mean, I think the whole exit from the California market has been more recent than the exit from the Florida insurance market. But when I look at these articles and I look at the consumer protection, I look at the regulation around ENS, I look at what's happening in Texas, in Florida, in California, the big vibe that I get is subprime mortgage loans.
Oh God!
I
Here
know,
we go.
I know. It's I'm not a mortgage broker. I'm not even an ENS insurance broker. But just this story that's going around and the underlying situation that's bringing this growth, right? Because at the same time, you also have to consider that growth in ENS is actually a decrease in admitted markets, right? Like this is not new insurance being placed. It's insurance moving from one section of the market to another section of the market. And then we look at a lot of these big insurance brokers, these big insurance companies, and they are partaking in the ENS market. Of course they are. They're insurance companies. This is what they do best. I mean, if you're going to go get ENS insurance, you probably should get it from one of the big guys who also have good operations.
Well, they're not technically coming from the big guys.
And that's
right?
exactly my segue, right? These big companies are setting up subsidiaries purely for ENS. Now, I'm not a lawyer. I'm not a lot of things, apparently. I've just listed 6 different things that I'm not. But I feel like that is a decision that they're making on purpose, right? In the sense that if we have another big event.
Well, they can't be, right? Regulatory wise, you can't be a sort of admitted carrier and then have a subsidiary that operates in the ENS market, right?
Well, I think I think that regulatory wise, actually, that's the reason they have subsidiaries, is because an admitted cannot do non-admitted placements.
Yeah.
Right. But then if you think about it on a liability perspective, in the sense that this is a standalone company and, we're just shareholders of that company, shareholders are not liable for the action of what the company does, right? That's the number one thing in the corporate veil, right? So for me, it feels a little bit, okay, everyone's trying to get into this market. They're trying to capitalize on the growth of it. It is more of a transfer or like a cannibalization occurring inside the market. It's obviously a fantastic opportunity for new firms, right? We're seeing a lot of ENS providers come in that are brand new. It was something like 97, 98 new ENS insurance companies since 2022, and over 200 new MGAs within the ENS space. So for those who don't know, an MGA is they represent someone else's portfolio. So it's either the people who already have portfolios going into ENS or the people who have a certain thesis going to someone with a portfolio and saying, hey, we want to provide ENS insurance. But it's such a booming market. It's a cannibalization of the existing market. The story and how this affects the actual end consumer is kind of crazy, because when I think wholesale, right, like our experiences here in London, I think wholesale, I think this access, this specialty market, I'm thinking millions in insurance, right? I'm thinking big ticket items are being insured in the Lloyd's market. And then I remember we were looking, I don't remember what the company was called, and it is nothing against this company. They're a software provider in ENS, but they were advertising, the business that goes through them. And they were like throwing examples on this, beautiful little visual of what their platform is. It was like $900, $1,000, right? I don't know what they were paying before. I think we found some articles actually that your typical ENS insurance is actually more expensive than your admitted.
Well, it has to be by definition, right?
Yeah, because of the taxes, because of the risk, because of the uncertainty.
Yeah. But to sort of loop back around to your comparison between, uh, you know, what we're currently seeing in the ENS market and perhaps what we've seen in the subprime mortgage situation, I think perhaps a difference there would be if we sort of push this ENS market to its logical conclusion and we do have a black swan event. What's different is that the whole sort of environment of derivatives being built upon the underlying mispriced and frankly unstable asset is different. I don't think we're going to quite see the same catastrophic sort of fallout, at least from a financial perspective, that we saw in the subprime sort of mortgage
Well,
loans.
well, yeah, from a financial perspective, maybe not. But I think if we bring this back to the end consumers, the people who were getting mortgages they couldn't afford,
Oh yeah, they'll
and
get shafted.
the people who, yeah, and the people who are getting insurance that will not cover them, right? Like, another Hurricane Ian occurs, but now, I mean, actually, what is the Florida ENS insurance percentage? 21% of all property insurance in Florida is ENS at this point.
It's actually quite a bit lower than I'd think.
Well, it looks like there's different sources. If you look at S&P Global, it's 21%. If you're looking at the Insurance Journal, it's hitting 50% this year.
Wow.
But imagine we have like a Hurricane Ian or God forbid a Katrina level event, and 50% of people paying for property insurance. That's, they're not all going to go defunct, right? Some of these ENS insurance companies are genuine insurance companies and they have good risk protocols. They understand the brand value of being one of the few to remain. But we're talking 300 new providers, right? 100 new insurers, 200 new MGAs. They're not all going to survive a black swan event, right? And that's going to leave the end consumers, these people getting insurance, in a worse position when this event occurs.
No, for sure. I mean, I think the vast majority of people who are getting insured by these ENS providers might not be able to recoup the full loss that they sustained during such an event. And, it's all well and good saying this, but I suppose we'll just have to wait until something like this rolls around to see how it plays out.
Yeah, I mean, it is a pessimistic story that we're telling here, right? This could be, we get another event, everyone gets paid out, and it turns out that the higher prices that people are paying for ENS were sufficient in covering the cost it took to insure them, right? Like, this could be, a Goldilocks type situation. I think it's primarily, like, for me, it's just that story that I'm used to when it comes to this excess lines, when it comes to this, wholesale type insurance, that it's something a little bit different, right? It's like that old, it's like that, I don't know if it's an idiom or a joke, but like, when you start hearing about a certain stock being discussed at your hairdresser, right? Like, it's probably
Time to sell.
it's time to
Yeah.
sell, right? Like, there's a little too much hype around it. And I guess that it's a good transition to kind of start to do a little bit of theory crafting. Where is ENS going to go from here, right? Because yes, it can cannibalize some of the existing market. But what really happens if we're talking about market dynamics is that now there's all of a sudden a much higher portfolio and a much higher premium amount going through a US domestic wholesale market, right? If we take away where this really came from, there is still more money in a specialty type market, right? And that's typically been a market that Lloyd's has had a absolute chokehold on.
No, that's absolutely right. And I think, this is part of a larger discussion as to why we've never seen anything quite like Lloyd's develop in any other region, right? I mean, you look at North America and it's like the place where you find by far the most capital, by far the most volume going through insurance, just naturally because of the size of the country as well as, the size of the economy there. But I think this comes back down to sort of competing interests, perhaps, and maybe not being able to facilitate the same environment that you find in Lloyd's in terms of, having a whole host of specialized underwriters as well as brokers.
Yeah.
And having them all sort of coexist and regulated to a high degree under one roof in Lloyd's, and having that same framework placed maybe somewhere like Chicago or New York.
But I think actually there's a different approach to why, and I think we can compare to Europe and look at the fact that insurance companies are regulated on a country by country basis in Europe. And what the real difference that ENS now provides is that there is coming a more competitive, more marketplace, more insurers in a marketplace that is not state by state regulated. Because that I think was probably the biggest differentiator to why we didn't see or why we haven't seen something like Lloyd's or a US equivalent of Lloyd's is because there would be too much state by state, regulation, right? In terms of where the funding is coming from. We were looking at the National Association of Insurance Professionals or something, and they were describing non-domestic, so non-US funding as alien funding, right? So they even do that on a state by state basis. Is your funding coming from Nebraska or is it coming from a different state when you're doing this insurance? Um, so I think that if the ENS market continues to cannibalize, right, and then they start to say, okay, well, we're taking a premium in states like Florida. What's stopping me from going to Wyoming using that premium, like not premium? So that's such a bad term because we're talking about insurance premium, but that extra amount that I'm charging in Florida for the uncertain, unregulated risk, and going to somewhere like Wyoming and saying, okay, I'm going to offer a discount compared to normal insurance because I'm making more in Florida, right? Let's say that this is in that Goldilocks scenario. It turns out that yes, they were able to properly insure Florida. So let's start looking at other markets until we get to a point that most US insurance is now non-admitted, right? And now there's all of a sudden a very, very big incentive to perhaps we should have some sort of Lloyd's type situation, right? I don't know.
No, I mean, I think that kind of thinking makes sense. I think, as we look at how the regulatory sort of environment has developed over the course of this administration, this sort of progression toward a more unregulated ENS dominated sort of ecosystem in North America doesn't seem like that far of a future, I suppose.
Yeah, I mean, I think that when it comes to regulatory and legislation in the US,
wait. We should probably talk about how you even get to ENS in the first place in terms of declination.
Well, that's actually so. I was looking into that. So what he's referring to is that we read an article that stated that you needed to have 2 declinations before you could go to ENS. So that means that you tried to get some admitted insurance and you failed to get admitted insurance for one reason or another, right? There was no one there, or the quotes you got were just too high. But that actually does that now, like, and this is the weirdest part about non-admitted admitted. There are still state by state regulations that change a little bit in terms of how non-admitted is applied, specifically around the taxes. But even this declinations piece is a little bit different. In Texas, they don't have that. In Florida, you do have 2 declinations. But what was really interesting when we were looking at the regulation was there was no explicit definition of what a declination meant, right? Because I'm sure you could go to Allstate in Florida, before they had officially pulled out, and you could get a quote that was, "Oh, last year you were paying $8,000, now you're paying $20,000." Is that a declination or is it just outrageous pricing? And can you or can you not go to ENS? I mean, we'd love to talk to some ENS brokers in the US because I think that we are obviously coming into this with very little exposure, right? We do have some insurance exposure, but within the ENS space, we have very minimal ENS exposure. And I mean, just looking at the articles we see online, like I said before, the only thing we can really see is how big is it growing, right? So, I mean, I don't have a good way to wrap up that sentence. I don't really have a good way to wrap up the discussion around ENS. I think it's just something to keep an eye on, both in terms of the cannibalization of the existing admitted market, in terms of the consumer rights and how regulation is going to change, because we have seen pushes from different associations, from different insurance bodies saying that we do need to align. Even if we're not going to be admitted insurers, we do need to align with some of the standards of admitted insurance. A lot of the regulation changes that I have seen recently have not been about the dynamics of the industry, but have been making it mandatory and explicit that you tell a client that they are not covered by state, right? That the state is not a backstop for this E&S insurance. But that's the only real regulation I could really see. I saw that in Delaware, I saw that in New York, which are states that don't necessarily have the largest E&S market, actually. If I look at New York, 8%.
Yeah, I mean that's a fraction compared to places like Florida and California, right?
Yeah. And that could just be things like cyber. That could just be things like cannabis producers. That could just be things like I saw this great Business Insider video about these guys doing oyster farming in the Hudson River or something. I mean, that's pretty unique. You probably don't have, many comparable clients to get some sort of standardized oyster farmer in the Hudson Bay insurance, right? So like,
well, I mean, I'm sure oyster farming's been around for long enough that your typical insurers would understand at least something about it.
Oh yeah, but I think the difference was that they were just leaving their cages in the middle of the river and like putting flags on it like it was scuba divers type thing. So like avoid here.
Oh, that's kind of sketchy.
Yeah. I mean the Hudson River. Never mind. I was going to say the Hudson River is probably not the cleanest anyway, but I guess that's the point of oysters.
Yeah. Isn't it like nature's natural sort of filtration system or something?
Yeah, we're gonna start going on a little bit of a goose chase here. But I saw this fantastic article of, I want to say Krakow in Poland. They have flood water diversion systems that use oysters. That
I've seen this.
Yeah, they open up because like when stuff starts flooding, it starts to pick up sediment and minerals from the streets. That ends up in the river. And all of a sudden, the oysters are like, this is dirtier than normal. Time to start eating. And they have sensors on the back of these oysters that open up. And that then notifies the city, hey, it's time to open the flood barriers, right? I mean, and I'm sure when we talk about climate change.
You know what that reminds me of? Okay, random segue. Did you see that thing about how how the Tokyo subway system was mapped out? They essentially got a bunch of gosh, what was it? Some bacteria essentially, put it in sort of a maze, and then had food for that bacteria mapped out in certain spots that kind of represented kind of the hubs or the busiest areas within Tokyo, and then they just let the bacteria grow. And the bacteria would naturally find the most efficient way of connecting all the different sort of places where the food was. And they use that as sort of the template for mapping out the overall subway system, which I suppose is why it's one of the most efficient and, well-run sort of subway systems in the world. Random aside. Sorry, go on.
I was on a random point before that.
Yeah, gosh.
But going back to ENS, I think one of the, like I said before, the traditional use of ENS, I mean, before this, before the big NatCat kind of changes we've seen in the industry, was things like cannabis, was some of these new and starting markets.
Well, crypto, right?
Crypto as well, and things like cyber, right? We're going to transition a little bit into a cyber discussion because there is something recent that's changed. Don't spoil it before I intro it. I'll start with a little bit about cyber insurance. I mean, cyber insurance is something that has changed a lot and is actually something that has followed quite quickly with regulation and how technology has changed, right? In the sense that it's one of the benefits of having these wholesale and these like excess and surplus markets is how agile and how quick they are to change to how risks are changing, right? The first pieces of like cyber insurance had a lot to do with actually bad actors in your company, right? So like you're a tech provider or you're a company that has data, and that guy decides to take a bunch of this data and go to a competitor, or he uses your system to look up someone he knows or whatever. That was a lot of the early 2000s type insurance, was intentional sabotage data leaks type by someone who worked there. And then we see these new things like ISO, right? Like, or not, ISO is not new, but like some of the newer pieces of ISO regulation, ISO 27001, for example, is quite literally about, do you have proper protocols in place for your employees, not just to get completely raw access to all the data, right? Is it behind lock and key? Is it encrypted? These kinds of things. And as these regulations become more normative and become more utilized, the cyber insurance changes, right? And then it's no longer, okay, we're not going to cover these events, but we will make the fact that you have ISO, you have these things, a prerequisite to getting cyber insurance, right? And it continues to change even today.
Yeah, I think, just focusing on the cybersecurity market and how things are looking over there, I think from an insurer perspective, they are forecasting that these sort of cyber attacks will continue to decrease in frequency over time. And therefore, overall price of premiums will look to somewhat soften.
Yeah, and I mean, and especially nowadays, we're talking about AI being used for technical development. We're talking about just the use of AI in general, right? Cyber nowadays has a lot to do with the privacy of data or the people's personal data, right? We look at what happened with Marks and Spencers. I'm not sure actually. Did we touch on that on the first episode?
No, I don't think we did.
But yeah, Marks and Spencers had a big customer data leak, right? Or not necessarily a leak. I think they were under a cyber attack, but it put a lot of private consumer data in jeopardy. And there's a lot of cyber insurance nowadays has to do with remedying not only the damages to the people affected, but even reputational, right? They cover specifically what is it going to take to either make up the loss in reputation, or how can money be spent to help fix your reputation afterwards, right? In terms of, do we need to implement something? Do we need an ad campaign? Whatever it may be. But it used to be, there are different types of cyber insurance, right? It's very, very different, right? Like you look at property covers property, but you look at cyber, there are so many subsegments of what cyber could really cover, right? And that's where these specialty, these wholesale, these excess and surplus markets really can shine, is when you need something bespoke for what you're working on.
Yeah, I think nowadays the main worry in cyber is less about the risk factors going into like whether a company might be more vulnerable to these attacks. I think that part of the equation is, for all intents and purposes, mostly solved at this point. I think a lot of it comes down to, a lot of the unknown and the uncertainty is mostly within, okay, how big are these claims going to be, right? You look at Marks and Spencers, you look at any company operating within the GDPR sort of regulatory sort of environment. As soon as any of this private data comes out, you're looking at pretty severe consequences, right?
Yeah.
And the scale at which these damages can occur, I think that's the primary factor that fuels a lot of the uncertainty in cyber, at least nowadays.
Yeah, I mean, from what I've heard, the premiums in cyber are kind of going up. But it's also kind of led to a little bit of what's the point of getting cyber, right? Because I know not every single big company gets cyber insurance. And the example that we're going to talk about momentarily is, I almost think they don't get it, because I haven't seen a single insurance related article to this cyber attack that we're going to talk about in just a second. But I mean, it's like they say in the the SecOps or the developer space.
Wait, do we have time to go into this?
We'll be quick. We'll leave it for next.
Maybe
time,
a little
but,
teaser.
Yeah, but it's like they say in the SecOps kind of space, that it's always easier to be on the attack than it is to be in the defense when it comes to this cybersecurity, when it comes to security operations, things like that. But what happened, the example that we're talking about, is Asahi's operations ransomware attack. So it turns out that a Russian hacker group called Qlin had done a ransomware as a service. That has an abbreviation, right? Like RAS, right? I saw that in the article. Like, I was like, we're doing software as a service, but what the hell is ransomware as a service? But it turns out that they specialize in phishing attacks. They were able to get some phishing attacks done on Asahi. And the details are still quite low. Asahi hasn't talked too much about this yet, because I think it's still ongoing. There's articles about, their Japan's favorite beer is not going to be on shelves this weekend, right? Because they decided to stop all operations during this ransomware attack. It turns out that they were able to get access to all vendor information, all staff information, all financial information, all operations information. When it first came out, people were assuming, okay, this has to do with the fact that they were able to stop some sort of vendor procurement platform, right? And that created delays. But it's coming out that it turns out Asahi has purposely stop their own operations while this is going on, because I don't think they've actually gotten QLin out yet. I saw a quote from someone from QLin. They were interviewed by a security expert who said that, we're not going to reveal how we did this. We're not going to reveal exactly what we got, but we are demanding something like $26 million. We have gotten a huge treasure trove of information here. And it seems like Asahi's response has been we're going to shut down everything. We're going to figure out what the hell went wrong, and then we'll pick things up on the other end. But I haven't seen a single insurance-related article about it. I saw one from Insurance Insider. Didn't even talk about insurance in the article. Like when Marks and Spencer's came out, it was all over.
I think that might, be more to do with the fact that Marks and Spencer's was in the UK. Asahi is somewhat distantly removed.
You know what? That is a good point. I did not try to Google it in Japanese. I might have found some Japanese insurers talking about it, but we'll provide an update next time on how that situation unfurls. But it's trying to tie this all back in some sort of beautiful bow here. It's excess wholesale. These kinds of markets are incredibly complex, incredibly interesting to see what's happening in ENS. We'll have to follow along as, maybe we'll do an update a year from now on the podcast, and we'll see, okay, how much has ENS changed? But, if we did an article or we did an episode 1 year ago, not much would have changed. So we're not here hoping for a large event to see how the industry reacts to it, but it is incredibly curious to see how regulation and how industry dynamics are going to change to this growing ENS market.
No, absolutely. I wonder if they're just going to pay it. I mean, that does not seem like a large amount to sort of be able to resume operations.
Yeah. As I said it, I was now uncertain if that was the actual amount.
I think Harsh can fix that. Or can you throw like an article up here? Perfect. Thank you, producer Harsh. Oh, production restarted 2 days ago.
All right.
Breaking news.
Breaking news indeed.
So did they pay it?
No, it was not 27 million. It was 27 gigabytes worth of files. I completely butchered it. Yeah, there's no specific number on how much that they were ransomed for. It doesn't say whether they paid it. Typically, legally, they're not supposed to pay these things. I'm pretty sure.
Casper, we're trying to get clips here. We can't clip if you're saying the wrong thing. We need that headline.
27 million gigabytes worth of data. All right. Are we wrapping up?
Yeah, I think we should, shouldn't we?
Yeah, we've yapped on for too long. It is my passion. Mo can tell you off podcast that I yap just as much as I do on podcast. But next time we will be discussing climate, which is a fun topic.
Climate change, is it real? Or is it just a hoax? Okay, no, it's real. I just want to put that out there. We're just messing.
We're going to clip that out of context and put that on all our socials. Thank you so much for listening, and we hope to catch you next week.